Imagine facing an unexpected situation tomorrow, a medical emergency, a sudden job loss, or an urgent financial opportunity. In such moments, the most valuable asset is not always the one with the highest return. Instead, it is the one you can access immediately. This idea forms a foundation of an important economic concept called liquidity preference. Liquidity simply means how quickly an asset can be converted into cash without losing significant value. In the world of investing, the need for ready cash plays a major role in shaping financial decisions. Because while long-term growth is important, financial flexibility is equally important. Liquidity refers to how easily an asset can be turned into usable cash. Cash itself is the most liquid asset. It can be used instantly for payments, emergencies, or new opportunities. Other assets may take time to convert into cash. For example, selling a house may take weeks or even months. On the other hand, selling stocks in the stock market may take only a few seconds. Because of these differences, investors carefully consider liquidity when building their portfolios. Liquidity provides a sense of financial security. When investors know they have access to cash, they feel more confident about their financial stability. This confidence allows them to handle unexpected expenses without panic. Liquidity also allows investors to take advantage of sudden market opportunities. For example, if the stock market falls sharply, investors with available cash can buy assets at lower prices. Those who do not have liquidity may miss such opportunities. However, liquidity often comes with a trade-off. Highly liquid assets usually provide lower returns. Cash kept in a savings account may be safe and easily accessible, but its growth potential is limited. On the other hand, less liquid assets like real estate or private businesses may generate higher long-term returns, but accessing that money quickly can be difficult. Because of this trade-off, investors must carefully balance liquidity and growth. Liquidity becomes even more important during financial crises. When markets become unstable, investors often rush toward cash or highly liquid assets. This behavior is sometimes described as a flight to liquidity. During uncertain times, people prefer assets that can be quickly converted into cash. This demand for liquidity often increases during economic stress or market volatility. Another practical example of liquidity preference is the emergency fund. Financial experts often recommend keeping several months of living expenses in liquid form. This money should be easily accessible in case of unexpected situations. An emergency fund acts as a financial safety net. It prevents investors from selling long-term investments at the wrong time during emergencies. Different types of investments offer different levels of liquidity. Cash and savings accounts are highly liquid. Stocks and exchange-traded funds are also relatively liquid because they can be traded quickly in financial markets. Real estate, private equity investments, and certain collectibles are considered less liquid. Selling these assets may require significant time and effort. Understanding these differences helps investors design a more flexible financial strategy. Liquidity also influences investor behavior during market movements. Investors who maintain sufficient liquid reserves often remain calm during market volatility. They know they do not need to sell their investments immediately.